1:01. I think time to get the show on the road. So busy show today. So we're going to slightly change the format. So we've got Andrew McHattie is going to join me in 10-15 minutes or so once I've run through this week's news. And he's going to talk a little bit about what's going on with discounts and share price moves and spreads and things. So that should all be quite interesting. And then our guest this week is Paul Niven, who's the manager of F&C Investment Trust, which is obviously one of the biggest global generalists. It'd be quite interesting to see what he's got to say about that. So without further ado, I should obviously draw your attention to the disclaimers, which I'm going to show at the end as well. We'll talk about some news. So a couple of things I want to focus on this week, and then some updates on things we talked about before. First off, we'll talk about Aberdeen Frontier Markets, which we're talking about because it's decided it's going to wind up. Civitas Social Housing, because it just announced results this week. And then we'll talk about NextEnergy, Syncona and Gore Street when I get to the end of the other two. All the way through, if you want to ask questions, you can put them into the Q&A function. But if you can't manage to do that, you can always email me, jc@martinandco.com, and I can pick them up that way. So let's start with Aberdeen Frontier Markets. It hasn't covered itself in glory, and this is really the reason it's going to disappear. As you can see from this slide, it's not very big either, so 30 million quid. That discount 7% was wider before they announced the news this week. It did offer a decent yield, which is one of the attractions. But the main problem with it is obviously being the performance has been pretty dreadful. And as you can see from here on the 10-year NAV returns, it's barely managed to turn in a positive return. That's 0.4% a year for 10 years, which is really not very much money at all. It's obviously not the only one of these funds that hasn't done spectacularly well, but Africa Opportunity is very specialist and doesn't even really represent the whole of Africa. And Ashmore Global is a hedge fund that's been sort of winding itself up for a very long time. So really, we're looking at Aberdeen Frontier Markets relative to things like BlackRock Frontiers, Jupiter Emerging Frontier Income, and Mobius, which has got an allocation to frontier markets as well. That's not that big. When we took this fund on as a client, which is 2016, I'd known it for quite a long time already because it was launched by people I used to work with at an outfit called Advance. So it started with life as Advanced Frontier Markets. And the arguments for investing in frontiers are pretty straightforward, really, and we laid these out in our first note. So first, the demographics are quite suitable for generating strong GDP growth. So we've got a young population that's growing. We've also got expanding middle class, and as they get richer, they spend more, so consumer stocks and things like that benefit. Because they don't have sort of legacy technologies, you can get this sort of technology leapfrogging, which means that they can develop quite fast. And you've got good examples of that in places like Kenya, where everybody banks using their mobile phones, which is something that very few people here do. But because they didn't have the legacy banking system, they just jumped straight to that. One of the arguments was that they're not very well correlated with developed markets. I think that's probably less true. And definitely in things like this COVID situation, everything goes down. And the same is sort of true with the financial crisis as well. But the one that definitely makes sense is this thing that because they're relatively undeveloped markets, stock exchanges, and there's not a lot of research, and there's an opportunity for active managers to add value. So it is possible to outperform the index. And it's definitely true as well that because of kind of risk aversion, global investors are very underexposed to this market. So when they do alight on markets being interesting, the flows of money that they can deploy can quite quickly shift stock values. One of the things that we wrote in the first note, when this is being run as a fund of funds, was the importance of looking at the stocks, the country specific risks as well as the stock specific risks. Because we have sort of unstable governments in some places, unstable currencies, all sorts of big macroeconomic influences can change the landscape of something, and that's really quite important. I think this is where it's all gone horribly wrong. So part of the deal when it was set up in 2007 was that after 10 years there would be an exit opportunity. And this was a 100% exit opportunity. I'm always a bit wary of doing these things. I just think it's prone to disaster, because if it coincides with general negative sentiment, you can quite quickly see things disappear. Performance was okay, but not brilliant. And the shareholder register was all wrong. It was full of lots of kind of discount players. And one of the reasons we've been brought on was to try and help shift that. And I thought we would start to make some progress when this happened. And the board said, well, this isn't working. Nobody wants to do this anymore. One of the arguments was because it was a fund of funds, there's a double layer of fees. What we're going to do is change the manager within Aberdeen, which is where it was sitting by that stage, and switch to investing directly. But the key thing that changed here was this thing that geographical weights now rise from the manager's stock selection decisions, which is, well, maybe we'll talk to Paul about that later, about how he manages this situation between investing in decent stocks and thinking about where the markets are. So instead of looking at the big macro picture and saying, I quite like Kuwait or Pakistan or Nigeria, and then deciding which stocks to hold in those countries, it was, I've got an amazing Nigerian bank, let's have some of this. I've got an amazing Pakistani cement company, let's have some of this, some of this. And the geographic weights came from those stock selection decisions. And that was a fundamental mistake. And you can see what happened here. So this chart is the relative performance. So this is Aberdeen Frontier Markets, NAV, relative to its benchmark. And before you get to the pink line was the old managers, the running the fund of funds, who used to worry about the big macroeconomic stuff and where we were. And then we shift to the direct investment and it all goes horribly, horribly wrong. And a big chunk of this was because markets within frontiers were getting upgraded to the MSCI Emerging Index, or the FTSE Russell equivalent. When that happened, is what I was saying before, you get a huge flood of money coming in going, oh, this is okay to invest in now. I'm going to stick some of my clients' money in. And the sums of money involved were enough to massively shift the values of stocks in these markets. So two examples there, Pakistan and Kuwait. So a little bit, the stock runs up in a little bit of anticipation, then MSCI says, yeah, we're definitely put Pakistan in the index, and the whole thing soars and goes mental. Then the promotion becomes effective, and all the hot money that ran into the market in anticipation of getting promoted to MSCI Emerging comes out again, and the whole thing underperforms again. And if you don't hold it when it's doing this, you lag the index by miles, and that's what happened to Aberdeen Frontier Markets. It happened in Pakistan, happened in Kuwait, happened in UAE, Saudi Arabia, you name it. Every time it got caught out. So because the performance wasn't great, the board said, well, we're going to give you an exit opportunity if it doesn't beat its benchmark for the 2 years to 30th of June 2020. Obviously didn't do that in spades. The sad thing, I think, is that 30 million quid that's in the fund is going to get lost. We have, as I've said already, got a range of other funds that are doing frontier markets one way or another, trading on relatively narrow single-digit discounts. I think any one of those could have been a rollover option, but it doesn't look like it's going to be the case. So that's Aberdeen Frontiers. Civitas is another one of our clients. Hands up with that. It's also a stock I hold, just a full disclosure. This was, I think it's a great fund, and it's been hit by sort of negative sentiment just from a couple of brokers. But the results that they announced this week show really what a quality investment I think this is. So the discount was finally eliminated again, as we'll come and show you later on. So that meant the shareholders got 20% return. The NAV edged up, and it met its dividend target. It's really all about generating income. I'll explain how it does that in a minute. That dividend is now covered by the income that's coming off the existing portfolio. It's been able to up the dividend target again to 5.4p, and it hasn't got its full allocation of debt yet. So it's maximum 40%, but the target is 35%, and we come on to why it's important in a minute. So it is providing specialist supported housing to people with mental or physical disabilities. This is stuff that has to be adapted to their needs. And one of the arguments has been that their rents are a bit higher than normal kind of local authority housing. But there is a good reason for this, because there's an awful lot of a specialist kit out that needs to be done to make these things suitable. And you can see some examples here. So this is one they've just finished in Wales with bed hoists and tracking and wider hallways and all that sort of stuff. This is another one that they're just finishing off in Wales as well. With things like a hydrotherapy pool, and so there's quite a bit of upfront investment needs to go in to make these things suitable, and because of that, they can charge slightly higher rents, and those rents are paid by local authorities using money that the government gives to them. So what you've got here is an income stream that's backed by the government. It's done on very long leases, so effectively you've got something which has got some of the characteristics of a 20-25 year gilt, but is a 5% yield instead of like a 1% or 0.5% or sometimes minus 0.5% now yield. So that's why it's attractive, really. It's got permission from shareholders to expand what it does. So it's going to, as well as doing this specialist supported housing, is going to have accommodation that provides to NHS bodies and to charities, and effectively that means things like nurse accommodation, so key worker accommodation. It's also going to do some stuff with local authorities on homelessness. So in this whole COVID situation in Islington recently, it provided a number of empty properties that they used to put homeless people in. And also step down accommodation as people come out of long-term care in hospitals, but not yet quite ready to go into their own home. So they're going to have facilities for this as well. This means actually that there's a huge variety of stuff that they're going to be able to do. And there is real need, I think, just across the UK to just get this thing going and invest in this area. So it's got a pipeline of projects worth about 200 million. It's got no unallocated cash to speak of. But what it has got is the ability to ramp up that loan to value ratio to 35%, which is about 120 million quid. So I think what we're looking at now is, given that the share price has finally come back up to where the NAV is, and it's now trading a premium again, it's going to be coming back to market and looking for more money. And I think it deserves to get it. It's obviously not the only game in town. There's another fund doing the same thing, but I think this is quite a good investment long term. So, a couple of just quick updates on things that we've talked about before. So we did a long bit on power prices and where they are. Just to say, NextEnergy results showed just exactly how that's been affecting them. So you've got a fall in the NAV, 110, well, was 111p down to 99p. And they say that in April, the demand for power in the UK was 15.3% below where it normally is. So power prices are very depressed at the moment. There is some hope that that's going to be bouncing back when economic activity gets going again. We'll wait and see whether that happens. There are obviously some long-term pressures on power prices, as we talked about before. You can go back and watch that in earlier shows. We talked about Syncona in some detail. It had some good news this week because one of its companies, Freeline, which is the one that's got looking at hematology and what it can do to cure effectively haemophilia B and a thing called Fabry disease, and behind that maybe haemophilia A and Gaucher's disease as well. It managed to raise some more money at a higher price that adds some value to the Syncona NAV. That money is going to be used to further those clinical trials, and it's looking at doing may do an IPO later on in the year. We'll have to wait and see. And if that happens, we could see another big uplift in Syncona again. And then Gore Street that we talked about last week, it's extended its pipeline. So it had an exclusive pipeline just of 20 megawatts. That's now up to 151, and that's out of 900. So it's got quite a lot of things it can do. And that's the battery storage people. So on that note, I am going to shut up for a bit and hand over to Andrew McHattie, who is the author of the Investment Trust newsletter, which is something that I've been reading for a very long time. This is there since 1996. Over to you, Andrew. That's,
Great, thank you very much indeed, James. Hello, everybody. I will just switch over to my screen as well. Hopefully that's come up. Good. I would just like to talk for a few minutes about some of the investment trust share price movements in June, and also a little bit about dealing spreads and what's been going on with those. I'll just echo what James had to say about the risk warning, and we're not giving any advice. So here's a list of the top 20 risers across investment companies in June, and I've just put on a filter to knock out any trusts smaller than 25 million, which I think those really are pretty tiny ones. That's a busy list there. There's plenty going on. My sense this month was that the gains in the market were quite scattered across a range of fairly speculative trusts. It had a bit of a spicy flavour to it. There's a mix there of some smaller trusts, some specialists like Crystal Amber and Marvin Bailey, the activists at the top there. Some trusts, I think, that lagged behind in the seen a bounce in certain things like Amadeo Air 4 Plus there. And I think a few misunderstood trusts as well, where it's taken a little bit of time for investors to catch up with them. And I've highlighted a couple there that I'm going to just talk about. The Mobius Investment Trust up 18.6% over the month, and RTW Venture up 14.8%. So let's just have a look at those two. Now, I think Mobius Investment Trust is quite interesting, and if you're only looking at it casually, I think it's quite easy to misunderstand it because it's managed by Mark Mobius and Carlos Hardenberg, both previous managers of Templeton Emerging Markets. You might well think this is a clone of that. That's really not the case. What they're trying to do here is to distill what they've learned over their many years of experience and to create a best ideas trust here. And so it's much more focused and it's very different. It's focused on smaller and medium-sized emerging markets companies, and they also want to engage with those companies to act as a catalyst to try and get them to re-rate so that they interact better with capital markets. And I think that's quite an interesting strategy we've seen from others in Japan especially. And there's some evidence at work. They have some nice case studies showing how they've been working with companies proactively to get that to work. They were quite fortunate that they entered the crisis with 10% of cash. A lot of that has been deployed now. Made their first investments in Africa, in Egypt, in Kenya, and South Africa, and also in Vietnam. And I think it's helped that the managers have been communicating a little better what they're doing. And they held a Zoom meeting last week, which I tuned into. And one point they made, which I hadn't previously understood very well, is that they are overweight in some of the really key buzz sectors of the moment. So they have almost a quarter of the assets invested in technology, almost 20% in healthcare. And I think once they got that message across, that's helped to narrow the discount, which had widened out to about 12 to 15%. It's come in now to 7.1. And you can see over the last 2 months, really, how the share price has recovered quite strongly. I think it's up again this morning. As we might expect, the managers have plenty of good reasons why you should keep investing. Carlos says that he believes the discount rating on emerging markets compared to the US, he said there's a discount of 65%, which is the largest he's ever seen. That does raise the open question, of course, of whether that means the emerging markets are relatively cheap or the US is relatively expensive, or a bit of both. We'll have to wait and see on that. It is a concentrated portfolio, and I think this is something we're probably all thinking about a little bit more after what's happened with European Opportunities Trust and Wirecard. There are some fairly chunky holdings here. Carlos says that if anything goes over 8%, then all of the alarm bells start to ring, and 10% of assets is their absolute maximum. So they will top slice holdings if they get too large. One final point that was in the news this week is that one of the 3 co-founders of the managers is retiring. I don't think that's a big issue for the trust, because this was obviously something that was planned, and I wouldn't think that would impact it too much. Moving on to RTW. This is probably not all that well known. It's a fairly new trust that joined the market in the autumn of last year. And I really didn't know very much about it at all. I had a meeting with the managers, which gave me some flavour of it. I think they're working hard now to try and raise their profile and get the message across. But it is one of those trusts that takes a bit of work to get to know, and I think it might take a while. It's probably most similar to Syncona. So they're providing venture capital specifically to the life sciences sector, and they're trying to invest over the whole cycle. So they're putting money in at an early stage and hoping to hold that all the way through IPO and afterwards. And it's in the nature of that kind of investing that you're going to have hopefully some big winners as well as some losers. And that means that you will occasionally get trusts that form a very large chunk of your assets. And that's what's happened with RTW. They have one particular winner, Rocket Pharma, which at the end of March was almost a quarter of the assets. So there's quite a lot of concentration risk here. They do seem to be an impressive set of managers, very specialist and have a lot of knowledge of what they're doing. And they have some track record as well. They've just had a win with Avidity Biosciences floating on NASDAQ. Obviously, not too many companies are IPOing just now. This one, which was 8% of NAV, actually before the IPO, jumps up on the first day of dealing, so it's very well received. A nice uplift for the NAV, which has been reflected in the performance of the ordinary shares. The managers are very keen to grow the trust. They really want this to become their primary vehicle. It's certainly their most public vehicle. So I think in terms of the development of their management company, they would be keen to see this grow and do well. But it does take a bit of analysis, I think, this one. It's not a big premium, 18%. And whilst we have seen this with Syncona before, it clearly means that you've got to think quite carefully about the embedded value in the portfolio and really dig into it. But it's an interesting trust that may be worth looking into a bit more. Turning to the fallers over the last month, there's quite a lot of property in there. Obviously, the sector is remaining under pressure, and I've noticed an increasing amount of chat now about office space and whether that is going to follow what's happened with retail and become a major problem for the general property investors. There was a piece in The Economist this week about how many office buildings might need to be repurposed as more people decide to work from home, or companies just decide it's an unnecessary expense. So it's been a tough time for some of the big general property trusts, but the two that fell most in June, BMO Commercial Property and Schroeder Real Estate, both down by about 20%, have one thing in common. Well, probably more than one, but one outstanding thing of note, which is that they both decided to pause their dividend payments in April. And they really haven't recovered much since that time. So that the share price has been pretty weak since then, and they're both on these very wide discounts of almost 50% to the last quoted NAV. Of course, you have to be a bit careful with that because there may be downward revaluations to come there. But I suppose, it's an interesting position that for many investors who are reliant on dividends, who are thinking about the income flows in their portfolios, particularly if they have holdings in commercial companies that have cut their dividends, they probably can't see much reason now to be buying these. And so that may be why their discounts are a bit wider than average and why there's been very little buying activity. In time, once they've got a bit more confidence in how the outlook for rent collection and their future income stream is playing out, these trusts might resume their dividends at a good level, and they might look attractive at that point, but that's obviously a little way down the line. So, it's an interesting story. I think it might be worth following those trusts. Something a bit different now, something that has caught my eye over the last few weeks as I look right across the sector and look at some of the smaller trusts that might be interesting, really hunting for price anomalies and that kind of thing. There's been a bit of an issue with dealing spreads really widening out. And I think I spoke to a couple of brokers about this, and they said it's really because market makers just don't want to take any stock on their books at the moment. And it's been a serious disincentive to deal in some of these less liquid trusts. I'll just give you three quick examples. The first one here is a trust that actually I have a bit of a soft spot for, Canadian General Investments, not that well known. It is a £300 million trust, but there's a very large family holding. The Morgan family own more than 50% of this, so the free float is much smaller. It does invest across Canada in financials and materials, that kind of thing, as you would expect. But its remit does also allow it to have some investments in the US where it can't get that exposure in Canada. So, for example, its largest holding is in Shopify, the US company that enables online stores, which has done incredibly well. it's an interesting trust. But the problem here is that the dealing spread in January was 3.3%, quite acceptable. It widened out at the start of April to 41.5%. And I think the point I'd like to make now is that although it has narrowed back in, it really hasn't come all the way. So it's narrowed back to 14.3%, still pretty wide, quite nasty. It's the same story for Premier Global Infrastructure, where the ordinary shares do have a small market cap of 20 odd million. It's a larger trust than that because it has zeros, but it's a problem for these shares. Again, the dealing spread started off in January at 4%. It's widened out to 20%, and it's come in a bit now to 9.1, but still something for you to think about quite carefully if you want to deal in those shares. The last one is JP Morgan Brazil. Again, a very small trust, 23 million. I'm not really sure this should exist. Obviously, JP Morgan wanted to have the, sorry if that's controversial, JP Morgan wanted to have the 4 brick trusts. So it's got Russia, India, and China. It wanted to complete the set. It has been interesting in the sense that Brazil has obviously been behind the curve in terms of the impact of the pandemic and has been a bit slower to recover and is still struggling, of course, with COVID. So an interesting trust to look at. But again, the dealing spread widened out from 5% to 12.2. It's now 10%. And I think as well, that was just impossible to deal for a while. There were just no shares available. So I think the overall message there is just be a bit careful with these smaller trusts, because in times of market stress, they really can be problematic. Liquidity can dry up. You can find you get stuck in things without being able to get out on a reasonable spread. Now, one thing I just thought about that is that this could yield an opportunity for some professional market practitioners who really are not looking to deal through the market. So maybe someone like Nick Greenwood and Charlotte Cuthbertson at Miton Global Ops, they could deal off market and take some of these shares off the hands of sellers who are not able to get a good price in the market. So it's not all bad, but I think for many ordinary investors, it's a pretty good argument for thinking about larger, more established trusts at this time. And I think on that note, that's probably a good time to hand back to James and maybe talk to.
Oh, no, thanks, Andrew. Let's just share my screen again. There we go. Cool. Yeah, no, thanks, Andrew. That was really interesting, actually. And certainly when I used to run a fund where we were looking to exploit wide discounts, one of the things that was the ability to pick things up below the spread because people were just stuck in liquid things. And that was one, for me, quite a good way of making money. But I just appreciate it doesn't really help everybody. Your comments about property stuff were quite interesting because we're actually sort of running a series of property conferences over the next few weeks. So the first of those is on the 8th of July, and we've actually got the Schroeder Fund as one of the presenters. So Nick Montgomery is going to be presenting. And we've also got Aberdeen Standard European Logistics, TR Property, London Metric, and Tritax Big Box REIT. So this is the first of the series that we're doing every week. So if you're interested in that and what's going on, then do tune into those, and there'll be some ability to ask some questions of some of those managers. It should be quite interesting to see what's going on. We normally need questions at the end, but just one quick one on RTW that came in while you were talking. So the question is basically, do you think it's less risky than Patient Capital was, RTW?
Yeah, that's a good question, and one that's obviously very difficult to answer. I think the answer is not necessarily, because it is investing in these early stage companies, and you would have to anticipate that some of those will fail and won't be successful. The difference perhaps is that this is an absolutely specialist fund. This is all the managers do, and they are absolutely embedded in this sector. They go to all of the major conferences and really get to know these companies very well. And I'm not saying that wasn't the case with Patient Capital, but that was maybe a bit more of a scattergun.
I strongly suspect that was the case with Patient Capital. I mean, I think that was where it went. I've actually written something on RTW for Citywire, so that'll be coming out on Tuesday next week, or Monday sometimes now. Because I guess they are ramping up their exposure. They're looking for more of a media presence. I do think it's an interesting company, and as you said, there's a lot of similarities with Syncona. So maybe once it's fully established, we might get them on the show and ask some questions directly. So we should now probably hand over to Paul. So it's quite cool that we can get the manager of one of the largest funds on here, and we're quite keen to hear about how it's going and how you actually run the money. I know you've sent me some slides, so I've got them on the deck. So by all means, Paul, if you just want to sort of say, change the slide, I'll do that. But why don't you sort of kick off with just a bit about how the fund's positioned now and how it's managed, because it's not a straightforward equity portfolio, is it?
No. So good morning, James, and thanks very much to all your listeners for calling in. Maybe I'll just stop on this slide if you can, James. So basically, the trust, as you said, is one of the oldest, in fact, the oldest, launched in 1868. So we've got tremendous history, but we've also got scale. So about £4 billion of net assets, and our market cap is around 3.7, 3.8 billion pounds today. So we are one of the larger trusts. And you referred to F&C as a global generalist in your earlier comment. So why is that the case, and why do we invest globally? Why do we invest into growth assets like equities and private equity, which we do? And how do we actually look to deliver returns? Well, our overriding objective is delivery of long-term growth in capital and income. And for many decades now, we focus very much on growth assets. So this slide here shows you a range of underlying strategies that we invest into. I want to say strategies. These are portfolios which are run directly on behalf of the trust. Listed equity, managed on either a regional basis or a global basis, but also private equity, which I think is clearly some of our competitors do invest into private markets, but within the global space, it's a minority of trusts that do take advantage of illiquidity and the opportunities that can bring in terms of investing into private markets. And just as an aside, again, by virtue of our history, we've been doing this for a very long time, investing in private markets since the 1940s. The overriding objective beyond growing capital and income really is to provide a one-stop shop for investors. So a global generalist investing across lots of different opportunities, looking for to provide a single solution for investors looking for exposure to growth-focused history too much. I do think it is relevant that we focused very much on the retail market. We were the first investment trust looking to provide investors of moderate means access to the same opportunities as large capitalists when we were launched in 1868, essentially looking to democratize investment opportunities. And I think that's very relevant today as we're over 90% owned by retail investors and well over 100,000 underlying shareholders. So maybe coming back to this slide and a bit more specific, we're diversified, investing into a range of strategies, diversified by geography, sector. Specifically, you can see that we've got a run by BMO, Global Asset Management, who I work for, but also by third-party managers, and specifically, or largely in the case of the US, where we actually outsource and have outsourced for many years the management of US assets in the growth and the value space to T. Rowe Price and to Barrow Hanley. I'll draw a few more points just from this chart, if I may. So you can see that we have a range of strategies. Each of these strategies typically have got a relatively small number of holdings. So in the case of Japan, emerging markets, 20 to 40 stocks, relatively high active share. And the principle really is of investing in a diversified manner, but giving managers a clear mandate. They typically run concentrated portfolios, and the reason we do that is because the basic principle that returns are additive and risk is not. So the basic principle of diversification is that by investing across different areas, different approaches, each of which is investing in a slightly different way, then you can provide better risk-adjusted returns for investors. If we take our growth manager, for example, they're investing very much in disruptive growth. The top 10 holdings account for around 30% of their exposure, so they're running quite a concentrated set of positions. But as I said, we look to diversify across a range of different underlying components. And I do think that this point that you may have been coming onto me with, James, was about the top down against the bottom up, and thinking about the balance of best ideas and stock selection against asset allocation. My perspective on this is, there's a philosophical argument here, but you can give a manager a global portfolio and say, go and pick me your best ideas. But if those ideas all reside in a small segment of the market, or one particular segment of the market, whether that is defined geographically or by style or by sector, you're going to end up spending a lot of risk on one particular outcome. So an example of that would be, if you're looking at a global manager and they are looking for the best opportunities, but they end up essentially spending all of that risk budget on disruptive technology, then it may well be that that is where the best opportunities reside, but you have to be aware that you're spending most of the risk on one particular outcome. So again, we look to spread risk across different areas, look for value added at the strategic level, tactical management of the portfolio across the opportunity set, and you can see that we've got a lot more in growth, in US growth than we do in US value today. And we also look for value to be added at the stock selection level while taking advantage of illiquidity through private equity. I'll maybe just make a couple more points, if I may, which will just elaborate on this point on how we manage. If you want to move forward one slide, James, then this just gives you a sense about where we started the year in terms of exposure and where we were at the end of May, and the picture is not so different at the end of June, actually. But the picture has been one of, for example, cutting our position in Europe, cutting our position in US value. We've trimmed emerging markets in Japan as well as income stocks, and put money into some more global managers, and specifically what we call sustainable global, which is basically quality, sustainable, growth-focused companies. It's got quite a growth tilt to it, as well as Preferred, who are part of the Be Most Stable, and they help essentially for us to hit our income objectives as well. So this is just a bit of a snapshot as to how the portfolio has actually changed over the short term, but the narrative really is, one, reduction in value exposure, and we actually did most of that before markets sold off aggressively. Secondly, and none of these things are necessarily independent, reduction of European exposure to fund some of our global strategies, and third, reduction on income-seeking strategies. And income, we've actually done very well in terms of our income component, but as your listeners will be aware, income has been an area that's been challenged because of the value characteristics, and clearly what we're seeing from a dividend perspective arguably makes it more challenging for many of these companies going forward. Maybe just move forward one slide and I'll pause. But this gives a sense of how the portfolio looks when you take all of those different strategies and you add them together in terms of geographic and sectoral exposure. And again, I think this is relevant from the perspective of the top down against the bottom up. And my view is one has to seek balance between manager exposure, the underlying managers are giving you, and what the portfolio looks like when you add it all together and you look through to all of those underlying holdings. So we've got almost 60%, and this includes private equity actually. So if you just did listed assets, it'd be more than 60% in North America, the vast majority of that being in the US, the next biggest area, Europe, in emerging markets, and so on, and around 23% of the portfolio in technology. So we've got a growth tilt. You could see that from the exposure between T. Rowe Price and Barrow Hanley, between growth and value. You can see that from a sectoral perspective, and also geographically as well, given what we know in terms of the makeup of the US market in particular. So the portfolio is managed as a global generalist, as you said, investing into listed, unlisted equities, diversified, but importantly running concentrated portfolios, each of which do something specific and which provide diversification benefit across other components of the portfolio, using internal capabilities from BMO, as well as external managers like T. Rowe Price and Barrow Hanley. I'll pause there, James.
Cool. Thank you, Paul. I mean, we've got some questions coming in that are kind of relevant to this already. So if I sort of paraphrase first. So how easy is it to adjust the asset allocation when you want to? Are they relatively liquid strategies underneath this that you can just dive in and dive out of?
Yeah, the short answer is very easy to adjust asset allocation, and we can do that either by selling physical stocks at the underlying level, and I would say with the obvious comment of private equity, because these are not listed private equity holdings, these are unlisted limited partnerships which have got 10 or 12-year life. So the private equity segment of the portfolio is very long-term in nature and illiquid. Small caps, by definition, have a lower liquidity profile than other parts of the portfolio. But aside from that, the portfolio is invested into liquid, listed, large cap stocks. So we can simply allocate or disallocate. And bear in mind, as I said, these are not investing into underlying funds. These are segregated mandates run specifically for the trust. And we can, with very short notice, hours notice, basically make those allocation changes, or indeed we can use derivatives if we want to manage positions or ETFs at the margin as well. So it's very easy to move the portfolio around. That said, I think you would expect a trust like ours to clearly take a long-term approach, and we don't move the portfolio around by tens of percentage of points on a short-term basis. It tends to be a long-term view, and we'll move the portfolio accordingly. So you can see between December and May, those kind of 5% type moves are probably in a historic or in a recent historic context at the higher end of the moves that we've made over that kind of time frame. But again, just without going on too much about this, in recent years, we've moved UK equities from around a third, 35% of the portfolio, down to only around 6% today. And indeed, we don't hold a UK strategy specifically. That sits within a pan-European strategy.
Yeah, I think that's probably sensible in the current market environment.
Yeah.
How does the charging work? So there's sort of an overall management fee that you then pay some of that to the underlying fund managers, or do they sort of charges separately?
So the OCF, which is the ongoing charges figure, is 63 basis points. And basically that represents the cost that BMO charge. And we have a tiered management fee which will go down to 25 basis points above 4 billion market cap. We're not so far away from that today. And as I said, that's on a tiered basis, depending upon the proportion of assets held at a certain segment. And then clearly there are fees which are payable to third-party managers. So T. Rowe Price and Barrow Hanley, LGM you'll see on there, and Purford, they actually sit within the BMO stable. So there are no additional charges for that part of the portfolio. Private equity, again, as your listeners will be aware, has a different fee structure, but that is also accounted for within the 0.63% ongoing charges. So BMO take a fee, and clearly there are additional charges by virtue of us investing into other opportunities beyond those that BMO provides.
Cool. Okay. And then how do you manage the cash and the gearing, especially through the sort of markets we've been going through?
Yeah, it's a really good question. So there's a strategic and a tactical decision here, clearly. And we've actually got quite a lot of long-term debt, which we've taken out in the last few years. And some of that debt we took out last year and extends out to 40 years. And I think provided a very, very attractive borrowing rate. So basically, if we can earn returns over the next 40 years above that, I think 2.8% borrowing cost, then it's going to add value for shareholders. But that long-term debt is not managed from a short-term perspective. What we do, however, have is a range of maturities on our debt, and we can use a revolving credit facility, which is basically like an overdraft or a short-term borrowing facility at very attractive interest rates to raise or lower gearing. We basically came into the beginning of 2020 with around about 10% gearing, which with the benefit of hindsight and certainly through the downturn was higher than was ideal. But we kept basically our gearing levels relatively constant through the downturn. And as the market rallied, we've actually taken the opportunity to take a little bit of gearing off the table. So we're currently around the 8.5% gearing level. So we've maintained gearing levels around that 8 to 10% level on a year-to-date basis. A diversified set of borrowings, average interest rate on those borrowings of around 2.5%, which again, from a long-term perspective, I think is quite a low hurdle rate for us to add value for shareholders.
Cool. Okay. So, and what's the dividend cuts around the world? What's that done to your revenue account?
Yeah, well, we're just obviously through the first half, and we're going through our interim results, which will be released in a few weeks' time. But I don't think it'll be, and that will lay out very clearly what's happened to our revenues in the first half of the year. I don't think it'll be a surprise to anyone that our revenue will be down quite sharply on a year-on-year basis for the first 6 months of the year. Now, I looked at this quite closely, as you would expect, and I think this downturn that we've seen in markets, and obviously the subsequent recovery, normally when you get a downturn in earnings, you tend to see a 0.4, 0.5 delta of dividends to earnings. What I mean by that is if earnings fall by 10%, dividends could be expected to fall by maybe 4 or 5%. This time round, that sensitivity is going to be a lot higher for a couple of reasons. One, obviously, because this has been a cash crisis for a large number of corporates, and therefore a portion of corporates just don't have any choice actually but to preserve cash and to cut dividends. And the second point is there's compulsion. For example, in the case of a large portion of European financials, they are simply not permitted to pay dividends. So I think it's too early to say what our dividends will be, what our revenue will be down on a first half basis. But I think at the market level, it would not be unreasonable to expect earnings down by 30% or thereabouts, maybe higher for 2020. And I think globally dividends could be down by that kind of order of magnitude. What I would say in terms of F&C, a few points. One, we came into the crisis with covered dividends, so we were earning more than we were paying out, and we've been accumulating revenue reserves. Secondly, our revenue reserves are about 1 3/4 years worth of dividends, so there's about 20.5 pence worth of revenue reserves per share. So we've come into what's a difficult environment, clearly very well placed to make up any short-term shortfall in terms of earnings. And we've paid a dividend in every single year since launch. So that is 151 years so far and 49 consecutive years of dividend rises. So 2020 should be the 50th consecutive year by which we raise dividends, regardless of whether our underlying revenue falls, and we're very well placed, and the board are committed to another rise in dividends in 2020.
Oh, that should reassure some people. I was interested, so you've got this sort of sustainable chunk here.
Yeah.
So can you just talk a bit about how you look at environmental, social governance type aspects when you're managing the fund, and how the underlying managers factor that into what they're doing?
Yeah, that's a really good point, and it's obviously become much more topical in recent years. BMO as a house, we used to be F&C Investments before we were bought by Bank of Montreal. We've got a really long history in terms of serious consideration of ESG issues. What does that mean practically? It means a few things. Well, first, all of our underlying managers, BMO or otherwise, are signatories of the UNPRI, which is basically Principles for Responsible Investment. BMO GAM was one of the founder signatories. Practically, that means that they take into account environmental, social, and governance considerations as part of their investment process when they make investment decisions. We've basically consolidated all of the voting on the portfolio. So BMO, our team, responsible investment team, take responsibility for all voting on the portfolio, regardless of whether BMO manage those assets or not. And we engage with our underlying holdings. So we raised over 600 issues with around 170 companies, voted over 500 company meetings in 2019. So again, we take our responsibilities very seriously. We ensure that ESG considerations are embedded within underlying processes. We use our vote because we think it's important, and we engage with companies on a range of underlying issues. And I didn't include a slide in the pack on this, but it's things like labour standards, corporate governance, environmental standards, and climate change. And there's a section in our annual report which covers gives more detail in terms of some of the activities that we undertake, and also how our portfolio looks from a climate change perspective. So, essentially the carbon footprint of the portfolio. And the investment into Sustainable Global represents another step forward, I think, in terms of progress on ESG issues. It's basically looking for positive opportunities in companies that can capitalize essentially on are well-run, good business practices, and aligned to many of the positive sustainability trends that we can see globally. And it's done fantastically well, I have to say.
Okay, I'm kind of conscious of time, really, so maybe we should be thinking about wrapping up there, although I've got more questions, but I think we should probably call it a day. So thank you very much, Paul, for that. That's really helpful. And I encourage people to go and look at your website, because there's lots of you've been doing on investor education stuff, which I think is really good as well.
Yes, just a couple of final points, if I may.
Sure.
Yeah, the share price, the share return you had there on just going back a few slides, that share price total return, what we've seen is a bit of a widening of the discount. We came into 2020 at a premium. The discount has widened. The board have been, through myself, buying back shares. We've got to the point clearly where the share register was very much imbalanced, enjoyed a premium, issued shares, but we are buying back, recognising, clearly that is accretive to NAV returns. And given where we stand in terms of, again, this point about the share register being in balance, I'm personally very hopeful and expectant that the discount will come in as we continue to deliver good returns for shareholders. But thank you, James, for the opportunity, and thanks to all your listeners for their time.
Cool. Well, thank you again. I should probably leave you on the disclaimer for a bit, so you take all that in about this is not advice and things go up and down. So we'll be back next week as normal. There's a few other things apart from the property conferences that we're doing. We've got a couple of other bits and pieces on the go. So I think on the 20th of July, you can check the events area, but we're doing a conference just on the impact of COVID-19 on markets. And we've got a few different managers in various different parts of the market talking about how that's affected them and their portfolio. So that might be quite interesting too. So on that note, I said thank you very much for everybody that listened in. Thank you very much to Andrew, and I shall call it a day and hopefully talk to you next week. Thanks. Bye-bye.